All right, let's get started. I saw something on the internet I wanted to show y'all and think about what we've done in this class. I don't know if any of y'all seen this, but this is a car accident. So I want you to think who's responsible, who should pay, and I'll give you some choices after we see the video, but let's just watch it. Any of y'all seen this?
Ohio, the police officer was smashed into that pickup truck.
Oh, what happened?
Okay, sweetie, you okay? The driver of the truck traveling with his young daughter also had dash cam with a bullet.
All right, so we'll look at the rest of this, but so who should pay? So just give you a little information. No one was injured, so that's good. Could have been pretty bad. The guy was pulled over to the side because the police were coming. You'll hear the guy say, the police officer saying, well, why are you over the side? Did you break down? It's like, no, I'm getting out of your way. Two police officers are already gone through with no trouble. There's other video of this police officer really struggling with the slick roads, something that his peers weren't having trouble with. Okay, so who should pay? The police officer? The police department? Maybe argue that, hey, they didn't train them very well. You live in an icy place. Do you think police officers are trained in driving high speed? Are they trained in driving in cold weather as well? Okay, the city, they're taxpayers. The owner of the truck, maybe you saw him doing something. Owner of the truck's insurance. Does he have a claim against them if he has insurance? All right, so based on right now, well, you can answer it from a philosophical standpoint or from a legal standpoint, but well, who should pay just philosophically? Forget about the law and insurance and liability. Police officer, he should come out of his own pocket. All right, whom do you think should pay it just from a liability standpoint? The police department, which is really the city. Okay, whom do you think is really going to pay for it? The city, the taxpayers? All right, well, you might be surprised. Let's watch.
The child, while frightened, could not physically hurt. Her dad, driver Conklin Lewis, suffered bruises. Their truck was totaled. Were you broken down? No, I pulled over 3 times. Okay, well, I didn't know. Yeah, no, I got it.
So he's somewhat admitting on tape that, you know, he messed up. So we at least got his admission.
Sorry about that, man. I couldn't stop. I guess it's all.
None of his peers did that. But I mean, it's pretty funny if you watch the rest of the video how much struggle he was having that day.
I'm glad you. I watched the video of the body camera through the police video. This is from February 2022. Three police were headed to a highway crash. Early on, the third officer repeatedly ran into snow banks and pushed down the vehicle.
Yeah, you can see he drives in the snow like I drive in the snow. My first time to drive in snow was in a brand new car that I just purchased. That was a lot of fun because I had a professor who required us to go to class in the snow. So.
The two officers in front of him never lost control. And after the police pulled him to the exit road, the third officer came to ram his engine and could not pull his picture back.
So sorry.
You okay? All right, are you okay? Snow got me. All right, radio. We have send permit on.
What does that mean? Send permit tone? I don't know what he's saying there.
Do me a favor, sir. Come over here.
Oh, okay.
Juliet Alpha, Kilo 1336.
And they block traffic forever because of this accident.
You gotta turn around. Here. You sit there, go ahead and sit. Can you speak English? Yeah. Okay, all right. Well, you weren't answering me. I know. Were you broken down? No, I pulled up for you guys. Okay, well, I hit the snow and yeah, no, I got it.
He's like, you know, the other guys didn't hit me. He's kind of a nice way of saying you're not a very good driver.
Nope.
He's clearly out of the way, right? He's actually even in the snowbank, so he did his best. I don't see. You see any liability on the truck driver's fault side yet? I mean, what else can you do? There's no place for him to go.
Sorry about that, man. Is all with is getting police. Now, you think this is flash and insurance company. And because the officers are part of a city agency and are responding to a call, the police and their insurance company are not responsible for any of the damage.
Does that sound right? Now, why wouldn't someone write a law that says not only are the police not responsible, but their insurance companies also not responsible? I don't know what legislature is thinking that.
And the officers are not involved in willful misconduct. This police officer may have been driving too fast for the icy conditions, but then technically fall short of willful misconduct. The officer did call for an ambulance, the 2-year-old child. Radio Sunday squad, there was a shot in the cars. Everybody's okay, but please check her out.
I don't think it shows us anything new. Maybe hear from the guy.
An odor was left behind. I just what I needed to do, said no, he was. I pulled over and I was hit, and now I am responsible for all the financials. I'm just a blue collar guy, you know, thousands of dollars is a lot of money out of my pocket to buy a truck. I was proud of that truck. I didn't make it out of there. What if my daughter didn't get out there? The police are not liable. You caused the accident. Be responsible for it. I don't care whether you are the law or not. You caused the accident.
Yeah, watch it one more time.
The police.
All right, so this is the young Turk, so he's gonna preach a little bit, but so it sounds like the owner of the truck, but what's the one big piece missing from this whole discussion? The very last one, isn't it? So you have to wonder, did he have uninsured motorists? Because you think that would cover the situation, wouldn't you? Or did he have Part D? Part D would have covered this. They don't mention if he has insurance. He's got a brand new truck. I would assume if he had Part D, that would have covered it at least up to the deductible. So I don't know if he didn't have insurance. And if he didn't, why he didn't have insurance. So you might put a little blame on him if he didn't have insurance, but it seems like, don't you agree he had a claim with his insurance company after all this happened? And it shouldn't affect his rates. Like what more do you want me to do? I'm obviously not at fault. At a minimum, they should have done a GoFundMe because they probably could have raised the money for a new truck probably in a few days. But essentially, they said no comment. We're not going to do it. All they would say is we're glad no one was harmed, but they refused to even talk about it. And it's like they were scared to do a GoFundMe because they didn't want to like admit any kind of guilt. So kind of sad situation. But yeah, I was a little bit shocked that now of course he could sue and all that and try to get something out of it. The law is the law. Do you think the law will change because of this? I don't know. This is February from a year ago, so who knows? But anyway, interesting case. But it is interesting they didn't mention his insurance company once, which you think would have been part of part of this discussion.
Kind of hard going up against an officer where he's very rely on the book.
He's heard the lie. Well, I mean,
He knows how to lie really well. And he's probably heard it.
well, he's being pretty honest when he came out. You know, it wasn't like, although he started off with why were you pulled over? I mean, it's I kind of get a sense he was trying to find an excuse. You can also, you know, you have the other officers who probably had a pretty good idea this guy shouldn't be driving around in cold weather the way he was driving. He was obviously a little out of control. But anyway, pretty sad story. I don't know what the result has been. All right. Yeah, I get that stuff on my Facebook feed all the time, and I'm always interested. I don't know why the young turks come up. I agree with them 43% of the time, and I strongly disagree with them 57% of the time. So maybe that's why they come up, but I don't know why they started coming on my feed. All right. So the pricing problem, let's look at it high level, because it is quite the math undertaking. There's no tricks on the exam though, so if you've got the steps down. So I'll put it in steps the way I think about it. It's probably the same steps that you would take. So step one is the forecast losses, LAE, and expenses from the current year to the next year. So we have the numbers for this year. Obviously, this year there's some forecasts in there because we're getting the entire year where the year is not over yet. Step two is to calculate float, present value, losses, LAE, expenses. The reason we're going to do that is, yeah, we know we're going to pay out these losses, but we're not going to pay them out today. We're going to pay them in the future. So we're going to have our losses, whatever they are, but we're going to earn some investment income while we're waiting to pay them out. So we didn't know that floats, so we can calculate the investing. Step three is calculate the underwriting gain or loss. Now here, we're trying to find a premium. The way I'm going to do it on the exam is I'm going to give you two premiums, and you got to figure out which premium is the right one. So you have to do this twice, once for each premium. But the nice thing is the sum of that step one and step two are the same either way. So it's not like you have multiple calculations. That's the only place where you're gonna have two different numbers. Step two is the one I really want you thinking most about, because that really is the key to this insurance equation, is this delay in that investment income they're going to make. Then you're going to calculate the investment income on starting net worth and the insurance float. So we're gonna have some capital set aside for this product. Remember, we're going to use the premium to surplus ratio. So that's going to be capital set aside. So if we set aside capital for this product, we get to earn the investment income on that capital. And then we'll also earn the investment income on the float. Now, this is not an obvious step because USA had a new CEO and he said, no way they're going to earn investment income on that capital. That's my capital. That's not their capital. So we had that debate. In fact, his argument was this product shouldn't get credit for any of the investment income. It's like, hey, that's my investment income. It doesn't belong. They shouldn't get any credit for that. I remember the meeting because he had just started. He was a banker. So I mentioned that, well, regulators are going to require you to count it. And boy, he got mad. He like slammed his fist on the table. And my first boss ever. She wasn't my boss at the time, but she was sitting there. She was the CFO. He goes, Susan, is that right? He goes, yes, that's correct. He was like, they shouldn't get any investment income whatsoever, but it's like, you don't have any choice. Your regulator is going to require you to give that credit. So what the regulators are saying is, hey, this is your money, but you're benefiting from it. You're making investment income on it. They should benefit from that as well in the pricing. All right. Step 5 is determine the change in required capital and the average required capital. I say required capital, remember that's net worth. I've been switching terms here. Starting net worth, required, I'll be consistent here. Net worth, it's the same thing. Remember, if in insurance and banking, capital and net worth are synonymous. That's not true with other industries, but it's true. Now here you have to do this twice because you have 2 premiums. Remember that our net worth requirement is based on the premium. So the higher the premium, the more you're going to have to set aside. Step 5, calculate net income and net income net change required net worth. So what is your net income? And then we're going to do something we did at UTSA is if your product required us to increase our net worth, we're going to actually ding you for that. Not every firm does that, but UTSA is, hey, we got to hold more capital for you. We're going to take that out of your net income. And then step 6, calculate your return on average required net worth. So those are the steps. It's possible in an exam you might miss one step or forget or do it backwards. That's not going to kill you if you can get most of them. So the key is to understand the process. So let's, oh, sorry, I can't count. Still thinking about that poor guy in his truck. All right, so let's look at each one and I'll write in the formulas as we go through them so you can see. So the first thing is we have claims, loss adjusted expenses and expenses for the current year. We want to get them to the next year. For claims and loss adjusted expenses, there's 2 items. One is the growth in frequency, which is how many accidents we're expecting to have. And the second one is the growth in severity. Usually growth in severity is related mainly to inflation. What we're replacing products, steel, whatever is up in price. Frequency can have several ones. Here we may be thinking in terms of just number of customers or number of cars or whatever. So we have numbers for claims, we have numbers for LAE, and they won't be the same. Generally, here they are the same, but they're not necessarily have to be the same. This severity is related to inflation of fixing the car or medical expenses. This inflation is related to the cost of your lawyers and payroll, so they can be different numbers. But you notice it's 3% and 4% and 3% and 4%, but be aware they can be different. So I probably do have an example where they are. I probably do have an example where they are different. Yeah, here you can see it's 2% in 5 and 2% in 4. Now frequency I do keep the same just because if there's more accidents, you're probably going to have more adjusters. There's probably going to be some relationship there. So 3 and 4%. So all we're going to do here, you're going to take current year losses times 1 plus growth frequency times 1 plus growth severity, because there is some overlap in the two. This reason. I mean, there's two ways you could do it. I could do 1 plus this growth rate plus this growth rate. But the fact that I'm multiplying them together, there's some interaction between the two. So they increase each other. So you can see how I do that in this formula right here. I take the prior year, 500 times 1 plus C18, which is the 3%, close parentheses times 1 plus C19, which is the severity. I don't know how much different that is versus if I did this 500 times 1 plus 3% plus 4%. It's going to be a little bit lower. Yeah, 535 versus 535.60. So what is that saying is that they influence each other, which is the better way to set it up. The exact same thing for LAE. Current year LAE times 1 plus the growth in frequency 1 plus the growth. Now, because I think on the exam, I started making the growth rates the same, mainly because if these are the same growth, 4% and 3%, 4% and 3%, you could just add these two numbers together and then multiply. That eliminate one step. That does make it a little bit easier, but if they are, the fact that they can be different means you need to switch it. And then expenses is a little easier. Expenses is just that times 1 plus growth in expenses. There's only one number here. Growth in underwriting expenses, 4%. There's no frequency and severity in that. It's just a growth. Now, if you like, you could sum the above because you're gonna need that number. So if I were you, I would just add them up right there. We'll see it when we get to the problem. So here we start. I give you the 500. I give you the 110. I give you the 120. We multiply it by the two growth rates. And so when you sum those up, you get 778.23, 778.23. That's going to be the same no matter which premium you're doing the math for. Those numbers are always going to be the same. All right, so the second step is the float. So we want to say, okay, these numbers are the numbers in the actual numbers in future terms. That minus those numbers in present value terms is essentially the investment earnings we're going to earn. We earn on that part of the business. So here, what you'll see we're doing, it looks like it's just a normal discounted cash flow. I take that forecast number and divide by 1 plus the investment return, 4%. Raise is C20. Well, what is C20? That's the claims timing. We have claims timing, LAE timing, and underwriting expense timing. Here you can see that the claims and LAE timing are the same, 0.75, and the expense timing is 0.5. Expense timing tends to be a little more front loaded because you do a lot of underwriting, do a lot of stuff up front, and it doesn't include LAE. So all the end stuff on LAE, that tends to be, that's going to be the same timing. So since underwriting mainly, there's policy service, but a lot of the underwriting is up front, getting the customer on the books. So what we're going to do here we're gonna take next year losses divided by 1 plus the investment rate raised to the timing. Same thing next year, LAE, exact same thing, just over and over again. 1 plus the investment rate raised to the timing. And then next year expenses. So it's a lot of calcs, but you're doing the same thing over and over again. Now, again, you might say, well, can't I just take the sum of this and divide it by 1 plus the rate to the timing? You could if the timing was all the same. But since the timing is not all the same, you have to do a few extra calculations. Right. So if you look here, the 535 in today's terms is 520. So we took 535. Took 535 divided by 1 plus 4% raised to the 0.75. So you might just practice that. 535.6 divided by 1.04 raised to the 0.75, and just make sure you get the right calculation. 520.07. Make sure you are y'all getting pretty good at exponent keys. I always have at least one student. Like, I don't know where the exponent key here is. It's x of y or y sub x. I don't know how they switch between the two of those. Make sure you know which those are. All right, so 520.07. And in here, the exact same thing. 117. It's exactly the same numbers because they have the same, they all have the same investment rate, and just happens here that the claims and the LA have the same timing, which is pretty common. So I guess you're pretty close. There's some rounding there. And then the same thing on expenses, except for with the expenses, it's 124.8, but raised to 0.5. I think there's this 122.38. Everybody's good till there? I'll put this document out on Blackboard. Now, make sure to stop and think about what you're doing, so you're not just memorizing stats, but you're thinking, all right, first thing I got to do is forecast it, and then I got to figure out that float. All right, now really is just kind of basic accounting. Your underwriting gain loss is going to be your premium minus the sum from step 1. So I'll give you a couple of premiums, but that's why I say you sum all of this up here. So your premium minus that total is going to give you your underwriting gain or loss. So if our premium was 779, I'm going to, whatever, I don't remember what I gave you. If it's 600, whatever it is, 600 minus the sum. So the sum of these three is 778.23. You write that number down once, and then you have two premiums. You just have to subtract twice. One of the premiums works, one of them doesn't. All right, so that's your goal, is figure out which premium works. All right, so that's a fairly simple equation. So you got premium option 1, premium option 2. You have a gain, you can't have a loss. It can be a gain or a loss. It is tough to get a loss and have this work out, given how low interest rates are when I do these problems. So usually we have a loss, you better have an 8-9% investment gain to offset it, or you're not going to have enough to make a return on equity. All right, this is the hard step. So let's look at this. There's two components to it. So the first one's fairly straightforward, where it's just taking the sum of the undiscounted minus the sum of the discounted. That's pretty straightforward, all right? There's nothing special there. So sum of step 1 minus sum of step 2. I probably should have said that on step 2. So step 2, sum the above. So step 1 was undiscounted. Step 2 is discounted. The difference between undiscounted and discounted, that's your float. We're going to add, now here's where I could have made it really, really complicated, but I didn't. Is I'm going to put a full year of investment income on that beginning required net worth. All right. Now, there are other investment incomes that I could do. I could give some investment income on the underwriting gain or loss, but generally that's going to be pretty small. So I'm throwing it out for materiality purposes, but in reality, there could be, I mean, if they're going to have a gain of say $20, that's $20 they get to keep for the whole year that they could earn. So I'm somewhat understating it. So I could do that, but it just gets a little too much. So I just want y'all to think about that. So that one's fairly straightforward. The beginning required net worth, because we're doing a 3-to-1, our beginning premiums were $750. So our beginning required net worth is $250. So we're going to add to that beginning net worth times the investment. What did I call it? Investment rate. Here's a step where I'm probably the most out of step with the actuaries, just because I'm trying to simplify the problem. Really, any cash flow this thing creates should get an investment rate on it. I just put in the most controversial part, is to give this product credit. You're having to set aside net worth. That's somewhat of a burden, but you are earning investment income on that while you're doing it, so you should get credit for that. All right, so this is maybe the hardest step. Everybody see how that works? We probably should have calculated starting net worth. Let me put that in there. It equals current year premium divided by 3. I should have put that there first. So your current year premium, why divided by 3? Because we're using that traditional 3-to-1 premium to surplus ratio. We're not using risk-based capital, we're using the premium surplus. So in this case, our premiums for the current year are $750. I give you that, but I don't give you this $250. So you have to know, I tell you that the premium surplus ratio is 3-to-1. So 750 divided by 3, and it will be 3-to-1 on the exam. I'm not going to make it like 2-to-1 or 8-to-1 or something like that. It's going to be 3-to-1. So your current premium divided by divided by 3 is 250. I'm going to let you earn investment income on that number. Go.
So on that formula, the parentheses, to get net worth times that order, or it's making it net worth times that rate. Correct.
Well, this whole thing. So yeah, this is already investment. You know, this is already adjusted for the investment return. Because remember, in step 2 we divided by the rate. So here, so yeah, you do this as one piece, and you do this as another piece. So I can even show you in the math. So I'm going to take 535.6 plus 117.83 plus 124.8. Y'all see those? Those are the undiscounted numbers for losses, LAE, and expenses. Minus 520.07, minus 114.42, minus 122.38. Those are the discounted pieces. Everybody see those numbers? plus 250 times 0.04. That gives me my 3136. All right, so here we need the change in required net worth and the average required net worth. We need a few numbers. So we know beginning required net worth. We already did that up above. That equals current year premium divided by 3. The next year required net worth, it's going to be premium option 1 divided by 3 and premium option 2 divided by 3. So you'll have 2 of those. And then our average required net worth is going to equal beginning required net worth plus next year required net worth divided by 2 for option 1 and option 2. So there's a few places you'll have to do this. You'll have to do this twice, and that's one place. So we started off with 250. This year I give you 2 premiums, so you'll have to figure out the 2 required for this time, and then the average, you'll have 2 of those. So you're going to have several numbers here. And then the last thing that we need, I'm going to put this down on the next page. And then the change required net worth, pretty simple. There you just take new year required net worth minus current year required net worth option and for option 2. You only have one beginning net worth. You'll have 2 required net worths, 2 average required net worths, and 2 changes in net worth, just because you have 2 premiums you have to deal with, right? But they're easy calculations. You're just dividing by 3. If you look at our current example, our beginning required net worth is 250. Our current year, if our premium is 600, 600 divided by 3 is 200. Then you need the average of that. Well, the average of that's obviously going to be 225. That's pretty easy, right? 250 plus 200 divided by 2. And then the change in that's going to be negative 50. It's going to have to come down 50. All right. Sees that? And then the net income is equal premium option 1 minus sum step. Well, we already did underwriting gain, didn't we? Let me simplify this. So we calculated underwriting gain. I think we did, didn't we? Or did we? Yeah, we did. So step 3 is underwriting gain. So underwriting gain from step 3 plus the investment earnings. Where do we do that? Step 4. In step 4, So in this case, here's our premium minus that 77823 gave us underwriting gain, here a loss of 178.23. Investment income was 31.36, so it gave us a net income negative 146.87. And then minus the change required net worth in step 5. So in this case, yeah, we had a net income of negative 146.87, but our required net worth went down by 50. So our net income less the change and required net worth was negative 96.87. And the last thing is you take net income less change in required net worth divided by, I can't remember if I do this average or beginning. I think I do. Oh, it's divided by average required net worth from step, whatever that was. Yeah, from step 5. Compare to ROE target and select between premium option 1, option 2. So this is our last step. So remember, we calculated the average required capital of 225. Our net income minus the change in capital was negative 97. You take negative 97 divided by 225. You get a return on equity of negative 43%. What do they need to make? They need to make 9%. Is that premium going to work? Doesn't look too promising. So let me give you another premium. We'll walk through this one. 779.72. So let's try it. So I'll do the steps all one more time, but I'll do it in formulas so that you can see. So the first thing I'm going to do is 500 times 1 plus 0.04 times 1 plus 0.03. Does that look right? Or 3 and 4. I did it backwards. Let me fix that. I'm going to take 110 times 1 plus 0.03 times 1 plus 0.04. There's my 3%, my 4% growth in LAE. Growth in expenses, 4%. So I'm going to take 120 times 1 plus 0.04. I'm going to add these together, 535.6 plus 117.83 plus 124.8, and I get 778.23. So I take 779.72 minus 778.23. Any questions up to there? Do I see where I got every number? All right. The next thing I'm going to do is take each one of these. So let's say our investment rate is 4% and our timing is 0.75 for a loss in LAE and 0.5 for expenses. So I'm going to take 535 divided by 1 plus 0.04 raised 0.75 and Just make sure you're getting exactly this number on your calculator, that you don't have a parentheses in the wrong place or something out of whack. Bill Gates doesn't like what I did. Still doesn't like what I did. Still doesn't like what I did. 535.6. There we go. So 535.6 divided by 1.0. And if you want to simplify, you can just, take out the parentheses and just, you don't have to actually put all that in there, but if you wanted to use the plus sign, just make sure you have enough parentheses there. All right, same thing here, 117.83 divided by 1 plus 0.04 raised to the 0.75. And then here, the 4% is going to be the same all the way down, the investment return. The only difference is the expenses timing is only 0.5. So 124.8 divided by 1 plus 0.04 raised to the 0.5. So 122, and then I'm going to add all these together, plus 520.07 plus 114.41 plus 122.38, and I get 756.87. Everybody good up to there? All right, then my investment income is going to be my 778.23 minus my 756.86. That's my float earnings. Let's get some capital in here. Let's get the beginning required net worth. Next year required net worth. Average required net worth and change required net worth. So my beginning net worth is 750 divided by 3 because my premium was 750 and I'm using a 3-to-1 expense ratio. My current year 779.72 divided by 3. My average is that is 250 plus 259.91 divided by 2, and my change is 259.91 minus 250. Any questions on that? You might just do it exactly like that. Just have it lined up so you got them all right there where you need them. And so my investment income is at 2137 plus my beginning net worth 250 times my investment rate 4%. That gives me 3137 or 36 rounding. So what is my earnings? It's going to be 779.72 minus my 778. My 778. I hate it when the number comes up. 78.28 plus 31.36 minus 9.91. Which of those numbers are you not sure of? 77972. Yeah, remember that one? Oh, wait. Oh, that's the premium. Excuse me. That's the premium. I guess let me do this better. Sorry. 1.49, right? You've already calculated that, the underwriting gain, 1.49 plus the investment earnings minus the change in required net worth. Everybody see those numbers? Underwriting gain or loss plus your investment income minus the change in required net worth. And so my return is then 22.94 divided by my average 254.96. I'm not sure. I can't tell when the numlocks. I wish it would give me like an electrical shock anytime I hit the numlock. And I get 9%. Now, I just did that. And it took me probably about 7 minutes. So it's not as difficult a problem as it seems because it's a pretty straightforward calculation.
There's some of the signs like 1 through 7, they look kind of scary to me. They look pretty easy there.
Yeah, I mean, it's really, it's a lot of repetition. I think the disaster is if someone forgets like a really key step up front and then they're like, what do I do now? I don't know what these numbers are. So I don't know. So probably the most important ones is to get the 778.23 and the 756.86. If you get that, you're probably going to get at least 50% credit for just knowing how to calculate
I
the
guess I
float.
recommend rewatch the video, looking at all the steps and seeing the example over and over again.
If I were you, I'd work the exact same problem multiple times. And then when you get the actual question, yeah, you maybe try. I generally, if I have 3 problems, I'll work the 3 problems and then I'll pick one of them. I'll just keep doing it over and over again.
Is the exam going to be on paper or will it be on?
This part's on paper. Yeah, I can't give y'all Excel because I can't control Excel. But they're not, you can see even here, I'm doing this in Excel, but I'm doing it with the calculator. I mean, I'm not using the formulas. I didn't use a formula anywhere in there. So I essentially use it like a calculator all the way down.
Any chance we'll be able to have the formulas with us or?
No. They're not that complicated formulas.
It just looks scary when you're showing them the first.
Well, you also have to realize you're not gonna think about this again until the week before the exam. So then it's gonna be like you've never seen it before in your life. So you might put into your notes that this is April 10th at 6:40 and go find that YouTube and watch this part again because that may make it seem a lot easier, right? It's like me learning a new software package. The trainer trains me, oh, this is so easy. And the next day you open it up, it's like, I've never seen this before in my entire life. So it's gonna leave your mind between now. Well, that's what I would always do with math problems like this. It's just there, I'm not gonna throw in, there's no curveballs for you to throw in on this. So it's the same calculation every time. So I would work the same problem over and over again. So if something happens on the exam, I can work my practice problem and see if I get the right answer and then go, oh yeah, I'm supposed to divide by 2 there or divide by 3. So, you know, it took me probably less than 10 minutes to do that. And that was with me talking. So, and having num-block problems. So it's not as complex, even just typing and calculating as it seems. Do make sure you've got your calculator down. Try to practice on the calculator you're going to use for the exam. Yeah, I can figure out how to give you more decimal places, but I'll probably have to Google it during the exam and find your particular calculator. So make sure you have the decimals on the right place. Make sure you know how to use the parentheses and use the exponent keys and all that. That's stuff that's just kind of standard. I know it's a lot easier in Excel, but still you can do it on a calculator. All right. So let's try a separate problem. I will show you next class. We'll do one more next class. I'll show you exactly what it looks like on the exam. This is what you're given. You're given 2 premiums. Let's say one of them's 804.03. You're given 2 premiums, and then you're given all of this material. So let me work one more, and then Wednesday I might give you one and just have y'all work it and see if you can do it. I'll pay 10,000 whoever finishes first, unless I change my mind. So I'll let you know right when I grade it. All right, so let's try step 1. We just got to forecast this forward. So 500 times 1 plus 0.02 plus 0.05. Nope. Times 1 plus 0.05. The 500 current year premium, what's the 2% and 5%? Frequency and severity, 2 and 5. All right, so we've used those numbers. And plus 125 times 1 plus 0.02 plus 0.04. We use those numbers. I forgot to put that this was I must have deleted a row. And then expenses plus 120 times 1 plus 0.03. I'll use that number. Now I'm going to add those together. 535.5 plus 132.5 plus 123.6. Then I'm going to take this 535.5 and divide it by 1 plus what?
Investment rate.
Investment rate. What is that? 0.05. And then I'm going to raise it to what? 0.5. Here's one where you could do them all together if you wanted to. So 132.5 divided by 1 plus 0.05 raised to the 0.5 plus 123.6 divided by 1 plus 0.05 raised to the 0.5. And we'll add those together, 522.59 plus 129.31 plus 120.62. You're okay just going out 2 decimal places. Rounding is not an issue. But you notice in this one, if I did 791.6 and divided by 1 plus 0.05 raised to the 0.5, I get that same number. Why? Because the 5% is always the same, but their timing was 0.5 on all three. So there you get the same answer. So if you notice that if the timing's the same on all three, you don't need these 3 numbers. You just need to take that number and do that math. So I don't know what I'm going to do in the exam. All right, so I've used this number. We're going to need it again, but I've used that number. I've used that number. Use that number. That number. So we've used almost every number. We're going to use the 5% again. And then we said we got beginning required net worth. Next year required net worth. Average required net worth. And change required net worth. Now, this may seem like overkill, but I'm just hoping you're getting the concept, especially if you're an actuary and you're interviewing. You can get this concept. Insurance companies and banks, they think about risk in net worth terms. How much net worth am I going to have to hold for this? And a good example is banking. I found it pretty shocking. Corporations have committed lines of credit. What's a committed line of credit? Well, committed line of credit is a bank that says, hey, if you need money, we'll loan to you at our current rates. And we're committed to do that. So if you come to us, we have to loan to you. An uncommitted line says, hey, we'll loan to you if we feel like it. Come to us, call us, we might loan you money, but we might not. But committed says we will. Well, with committed line of credit, you got to pay the bank even when you're not borrowing money from it. It might cost you 10 basis points. So like USA, you may have a commitment of $3 billion. And you got to pay them 10 basis points. So they make $3 million and they don't do anything but just promise. That sounds like a great business, doesn't it? I even offered USA, hey, I'll do a committed line for you, 10 billion. And then if they came to me, I say, sorry, I'm insolvent now, I can't do that. But banks hate doing this. Why do banks hate doing this? Looks like free money, does it? But they hate doing it. Why? Because they have to set up so much capital behind this business that it's not worth it to them. It's a strange business. $3 million are doing nothing but just saying you'll be there when they need you. And yet they don't want to do it. When they do committed line, they were like calling me, Ron, we got to give them some business. Can you give them some trades or something? Or like, we promised them if they give us a committed line, we'll give them some other business. I was like, I was like taking my trades and dividing them into 4 different trades. Yeah, they can have my February and May trades. It's like someplace they can make some money. So this idea of risk in terms of how much net worth you have to hold is really important for banking and insurance that you don't really see in any other industry, and you probably haven't heard in any of your other classes. It's a very, very different way of thinking. I think most insurance companies, if you interview with them, be pretty shocked that you had that concept of risk. Is yeah, risk. We got to hold more capital. It's going to require return on capital. Everything's going to be higher. So our beginning net worth is going to be our current year premium divided by 3. Our new year is going to be our new premium, next year premium divided by 3. The average can be 250 plus 268.01 divided by 2. And the change is going to be 268.01 minus 250. Any questions on when I got those numbers? This is the part students kind of forget, but it's, if you just get in the habit of writing out like that, you'll probably be fine. And so then we can do our net income less change required net worth. So we take our premium 804.03 minus 7. Oh, wait, forgot a really big piece here. Let's do our investment income. Any takers on that one? 2 steps. Without looking at your notes. Would these 2 numbers help you in any way? Any takers? $791.6 minus what? 72.52 plus what? 250 times 0.5. All of that makes sense. Shall I remember that? I really think the investment income is probably the place students have the biggest problem remembering. If you get completely stuck on the exam, just say, I completely forget this part and just write a number in and use it for the rest so you can get credit for everything else. It's so important because that's the float piece. And the bulk of it is the difference in these 2 numbers. That is the bulk of it. And that's about 20 of the 31. And then our net income less change required net worth. So we take 804.03 minus 791.6 plus 31.58 minus 1801. 804.03 is what? Next year's premiums, you have 2 of those. 791.60. That's the sum of your losses, LAE and expenses, but undiscounted. 31.58. That's your investment income. 1801. That's the change in your net worth, required net worth. And then you have your ROE plus. Wow, how could that be possible? Wow. Well, it's not exactly 26, but it's pretty close. Probably because my ROE is a very, very round number. So plus 26 divided by 259.01. So that 26 divided by my average required net worth gives me 10%. So it looks like this premium looks pretty well. Now, in reality, they're not going to file this 80403. What they're going to file is 804.03 minus 750 divided by 750. What they're going to file is that they need a 7.2% rate increase. That thick package of numbers, and all they say is, hey, we want a 7.2. Now, the state's going to look through all those pages, figure out where did this 10% come from. We use that. We've used all of this. We've used all the numbers here. That's the other thing. I don't give you numbers you don't need. I could do that. Would you love that on exam? I throw in some strange number, but you know you made a mistake if you didn't use everything on this page, right? So that's all got to be there. I don't tell you to do this, but you know that is what you follow with the state. We need that kind of increase, and then in reality, you know you're not going to get more than 5%, so you just ask for 5, even though you need 7. All right.
When do you think this, lecture video will be posted?
By Friday usually. It takes me a good 8 hours to do a class video. Just not. It takes my computer about 8 hours to do a class video. So I don't know what y'all, but y'all get it on Blackboard, don't you? Before then, it'll probably be on Blackboard tonight. Yeah, I don't edit that, so I don't know what all's in that file. But that file disappears after a few weeks. So the one on YouTube will be out there permanently. And there are videos of this. I think on Blackboard there is a video of this.
Just the, so.
I think I put one in here. Yeah, if you do it's called Schedule P examples. Yeah, I know there's a YouTube link somewhere for these, but there are. So I didn't label this very well. The Schedule P examples include more pricing examples. Examples too. I could have sworn I had a YouTube link in one of them. That one's just Schedule P. So the second one is only Schedule P. But that first one, I should have labeled that one better. So this first one here includes both Schedule P and pricing examples. So you do have more. The nice thing about these examples, if you look at them, this is what we'll do on Wednesday, is they show exactly what it looks like on the exam. This is what you get on the exam, which is real similar to what I just did in Excel, but at least you see in Word what it looks like. So it's going to look exactly like that. I give you all this information, and then I give you 2 premiums. I don't highlight the one that's right, but in this example I do. Now you might say, well, if this gets us, this is pretty important. If this gets us the required 10%, and this gives us 32%, why don't we do that one? Well, you can't do this one for competitive reasons and regulatory reasons. The regulators won't let you do that. And competitively, you can't just charge that much over your competitors. So even if you get more than the return, you got to get as close. You got to get as close to that return as you can. All right. So you want something around 10%. You don't want something 20-something percent. Okay. We'll work one more on Wednesday, give you more practice. And yeah, this is back when I knew a Spurs player that I could name a company after. Right? Anybody know a Spurs player today? I haven't watched the game in so many years. Okay. All right. Not to pick on the Spurs, poor guys. All right. That's it for tonight. I'll do both premiums just so we can see them. Our current year premium is $650. We have claims, LAE, underwriting expense, underwriting gain, investment earnings, any net worth. Next year, net, I'm gonna say required net worth. Beginning required net worth. Next year, required net worth, change. Average. There's a bunch of those calculations, but they're not all that. They are what the title says, so that makes it good. Net income less change or net worth and ROE. So those are all the pieces we're going to do. I'm going to give myself 3 columns. So our claims were 470, 60, 115 for underwriting. So 650 minus 470. 115 is 5. Okay, so my next year's claims, pretty straightforward, is current year claims times 1 plus 3%, which is our frequency, times 1 plus 2%, which is our severity. Did y'all get that? 493.78. And the same thing for LAE, 1 plus, except for it's 2.5% and 2%. 62.73, that sound right? And the underwriting expense, I only have one number here, 1 plus 225. So that gives us an underwriting gain of a loss of 194. Doesn't mean it's the wrong answer, but given how low the investment rate is, probably it's not the right answer. That's the exact same for both products. So those 3 numbers you don't have to calculate twice. The underwriting gain will be different though, because your premium is higher. And then we'll do the present value. So the present value you take, so Enrique was asking me about this. So it's 18 months. So N equals 0.75. We really didn't talk about that before. He said, okay, 18 more months, why isn't that 1.5? 18 months is a year and a half, but we're using 18 months is on average, we're going to be paying this over the next 18 months. If you use 1.5, you're assuming you pay all of it exactly in 18 months, but you don't, you pay it out. So what we do is called a mid-year convention. You just, or the mid, here is not a year, but you just assume 100% gets paid at the half point. That way you kind of have 50% before, 50% after. I did have one student, do the math and say, no, it's not really 0.75. It's like 0.75132, something, but 0.75 is close enough. So 18 months, the example I think we did was 1 year. And so there, the N was 0.5. But I give you the N, so you don't have to worry about that. You just use the N I give you. So present values, take that divided by 1 plus our investment rate, which is 3.5%, raised to the 0.75. Does that number look familiar? 481.20. Anybody get that number? See anybody shaking their heads? All right, Joshua, you did. Nicholas, okay. Same thing here. Divided by 1 plus 0.035. Raised probably to the same. Yeah, I kept them all 0.75, so that helps. So what we want to do is sum these numbers. So 493.78 plus 62.73 plus 717.59 And then 481.205 plus 61.1322 plus 114.592. You don't have to really go out that many decimal places. And that's going to be the same for both of them. So we don't have to you don't have to do that part twice. It's the same. All right, so that's where all the heaviest calculation is, but you only have to do it once because there's no premium impact on those two numbers. So that's kind of nice. Whatever you got on those, that's why you should probably write these numbers down so you can use them again. All right. Investment earnings, that's the tough one, right? But the investment earnings, you start off with the difference in these two, that minus that. Let's get our net worth. So our beginning net worth is the 650 divided by 3. The next year is going to be, well, let me do it.
I apologize. Could you please go back to the 674, then one lower. So
Yeah, so you add up the claims, LAE, and underwriting expenses undiscounted, and that's the first number. Then you add up the discounted number, because that difference is going to be your investment earnings. So you need the sum of this column, and you need the sum of that column. It's going to be the same no matter what the premium is. Okay. All right, and then 650 divided by 3. Bill Gates, for some reason, thinks. Yeah, I'm going to come back to investment earnings. So let's get the required net worth. So here, 672.16 divided by 3. Here we have. So this one's going to be the same. And here's 718.86 divided by 3. The change is going to be 224.05 minus 216.67. Here it's going to be 239.62 minus 216.67. And then we do the average. 216.17 plus 224.05 divided by 2. 216.67 plus 239.62 divided by 2. So when we do the investment earnings, we're going to take 674.1, the sum of these three numbers, minus 656.93, the sum of these three numbers. That's going to be the same for both cases because the numbers are exactly the same. So all we have to do is add to that. Well, actually, investment earnings, it's going to be the same in both cases because we're taking the beginning net worth times our investment earnings. So you should have gotten the same investment earnings both scenarios. All right. So where have we gotten different numbers because of the premium? The underwriting gain is different. And then these three net worth numbers. The next year, the change, and the average. But other than that, all the numbers so far have been exactly the same. All right. So you don't have that many differences that you have to do. Questions up to that point? Has anyone gotten numbers that far down? Where did y'all lose it? And then net income is just going to be your underwriting gain 1 minus 194 plus investment earnings here 44.76 plus 24.75. Take that 22.81 minus your change in net worth. I mean, it's possible I have an error in here. We'll see. And so that we're going to take that 15.43 and divide it by our net worth. I mean, our average required net worth, which is 220.36. Oh, that actually looks like it is the right answer. Plus 46.56 divided by 228.145. So it looks like the right answer is the lower premium. I'm kind of surprised on that. I got exactly 7%, so that's a good sign because that's the required one. No one got 7%? This whole room? Ah, wow.
Get lost in the steps, to be honest.
Well, that's why I say you gotta step back and think what you're doing. So this is a case where one of the most powerful things you can do with a bank or an insurance company is walk through their balance sheet and income statement, walk through their income statement. It's really, banks, it's almost even more valuable. If you can do that, you understand what's going on with the business. You understand the float, you understand the investment versus the underwriting. But you get a lot of partial credit, so you just practice it and practice it. It's not that difficult a problem once you do it a few times. Don't Gilbert?
Is it possible to have an Excel sheet and put it on Blackboard? I think it'll help out a lot.
Well, you have one out there already, don't you?
With
This particular one? You
Yeah.
can, I mean, it doesn't have the formulas in it. I'm just manually typing the numbers.
But I mean, that's what I mean. It's much better if you have the numbers.
Yeah. Well, where did y'all break down? How many got negative 194? Cassandra, you did?
I put down the net income part. I have.
You have a what? Oh, okay. Did anybody get 2475? You got that? All right. If you got the 2475, you're probably gonna get like 80% credit because that's kind of the hardest part. It's probably the most important because of understanding the float. So if you're getting stuck in this part, yeah, it's just because there's just a bunch of calculations. So it's just a matter of making sure you get it. If you remember these four things, none of them are hard. Beginning required, net next year, change, average. It's just plugging in the numbers. So just being careful with the math. Yeah, so the net income is just the underwriting gain plus the investment gain. So there you just add those two numbers together. So you're adding minus 194 plus the 2475. Here you're adding 4476 plus the 2475. Then you subtract out that 738, which is the change. You went from 216 to 224, subtract out that. Here you subtract out the 2295, and then you divide it by the average net worth, 220.36 and 228.145. I'm kind of surprised the lower premium is the right answer because underwriting gain was lost, but it still worked out. So it's possible to have an underwriting loss and still make your required capital. Maybe the issue here is that the required return on capital is pretty low. 7% is not that high of a number, so that may be why they're able to make it. Now, why wouldn't you have 20%? That's a lot better, but no, the regulators aren't going to allow it. Your competitors aren't going to allow it. So so make sure you pick the closest one. All right. You'll have this video. So we did this around 6:25. Well, I'll delete the first 35 minutes. So the video for this class will start when I start working the problems. So you'll have this class plus the last class. So you have some videos to watch. And this is an entirely new problem. So now you have an entirely new problem to work. You have other problems out there. So if you want to work the other problems, I think the cool thing about the other problems that I gave you is you have the Excel spreadsheet. So if you just plug in the numbers, the Excel spreadsheet will give you the answers. So, you can use that Excel spreadsheet to check your work. But if you need more problems, I can give you more problems. It's going to get a little bit overkill after a while.
They're gonna look like this, right?
Yeah, this is the exact exam question from last semester. Yeah, looks exactly like that. If we did it in Excel, I wouldn't actually give you two choices. I'd just have you use GoalSeek to find the right answer. But since we can't do exams in Excel, I just give you two choices. Now, what do actuaries do? Actuaries actually have a formula that comes to that it's a pretty incredible formula. And I'm just not going to show it's just way too much of a formula to try to calculate. I mean, obviously we could figure out a formula that does all of that, but that's just too much. So giving you two choices using GoalSeek is the best solution. Now, I don't know if this is exactly 7%. Yeah, man, it's pretty close. That's a wonderful thing. If you get exactly 7%, you're pretty confident you did it right. Because you know one of them's gonna be there. If you get two that are both wrong, then go back and look, but if you're gonna I give a lot of partial credit in this. There's no essay, so it's not like you have to write stuff. It's just give me the number. Some of y'all got lost points on the last exam because of the on the PML. All right, so the official answer is they're gonna, I don't count on this, but they're gonna increase their premiums about 3.4%. That's what they'll file with the state after all of that. All right. The steps probably helped, right? Some of y'all are looking up there. So that'd be good help. I don't think I put this out on Blackboard, did I? Or did I? Can't remember. I guess that y'all would probably want that. I don't know where to put it. I'll put it under miscellaneous. Let's see, it's probably already out there, and our risk management class, I put an assignment out there twice. As confusing as you could be. Let's see. No, it's not there, so I'll add it in here. I don't know what to call it, but pricing problem steps. Would that tell you what it is?
Go back to the Excel spreadsheet when we have a chance.
It's all right. Ricky. Yeah, my fear is you're gonna be plugging numbers and not thinking about what you're doing. You really gotta step back. The wonderful thing about this problem is it really shows you what float's all about. If you understand what you're doing in these two numbers, it's that whole idea of delay. It's really unique to banking and insurance. But banking's different, it's not like you learn insurance, you got banking down. One thing I thought was really helpful for me, if you work in this industry, I started in the life insurance side. And after 2.5 years there, I then started working on the P&C side, and it was a very easy transition. I was able to figure out P&C pretty fast. So there's enough conceptually with reserves and all that kind of stuff. I then went to banking. Banking was a little bit of a stretch, but banking's easier than insurance. So it was easier to learn just because it wasn't as much, but it does have some unique quirks to it. These are very unique. Someone was asking me today, how do you value banks? And I say, well, you don't use free cash flow. And he says, oh, okay. Because he tried to use a model and it didn't bring him free cash flow. So why am I not getting free cash flow? Because banks, insurance companies, they don't have free cash flow. If you know the concept of free cash flow, let's do Chubb. So we typically think of free cash flow as cash from operations minus CapEx. So 11 billion minus 1.7 billion. So it looks like they have a lot of free cash flow. You can't do that with banks and insurance companies. Why not? Well, this 11 billion, it's true that cash came in, but that 11 billion was them accepting risk from other people. So that's not just a growth in their business, it's also a growth in the risk of claims they're going to have to pay out into the future. So the cash from operations for banks and insurance companies, it's both business and risk, and you can't distinguish those two from each other. And so we just don't use the term free cash flow with banks and insurance companies. I've always believed that because that's the way I was we did at USAA, but I never wanted to say it in class. And then Dr. Demidarin at New York Stern said the exact same thing. Okay, good, I'm safe. If he's saying it, I can say it. Banks and insurance companies don't have free cash flows. So, don't bring that. If you're talking to an insurance company, don't bring up some free cash flow model that you're building, because it doesn't make as much sense for them. And it's just the nature of the business. Yeah, these premiums coming in this is risk. They're promising to do something in the future. And so a big growth in that just means they're probably going to be paying out a lot into the future. And that's part of that float, is just because they had a lot come in now, the claims may be next year. And so you may just be completely overstating their true value. So they were saying, well, how do you value them? They're tough. Banks and insurance companies are hard entities to value. They're really, really very unique. All right. So you got that out there. Okay, so we've covered this pretty well. All right, so we're going to get into this Schedule P. One thing that's really hard for finance and accounting majors to understand is the difference between accident year and fiscal years. Finance and accounting, we think in fiscal year terms. Actuaries think in accident year terms. So when we get into Schedule P, we'll see that. I'm going to come back to this because it doesn't really fit here right now. It's an important concept, but I'm going to come back to it. All right, so what I want to do is I want to talk Schedule P because we're in here now. I should bring up another insurance company to see some differences, but I like using Allstate's. Any of y'all Allstate customers? I don't know what kind of commercials they're doing right now. So I'm going to go into the corporation and look for the investor relations piece. And they have their statutory statements, which is pretty cool. Let's see if they have 2022 yet. So AIC is Allstate Insurance Company, but they also own a life insurance company. So you'll notice those. But what you'll notice is they don't have their annual report yet. They do quarterly. This is a statutory. We'll talk about statutory versus GAAP here in a little bit. They do quarterly filings with the states. So I think we're still stuck with 2021, unfortunately. So this is the Allstate Insurance Company combined annual statutory statement. Now you must say combined, so P&C and life, but no, it's only the P&C. They never put P&C and life companies together on the statutory side. There's been talks about that, but I don't think they've gotten anywhere. Here's all the companies that they have. They have a lot of companies, don't they? Well, we'll get into this because it's really quite interesting. Right, look right there. They got a Texas Lloyd's. We talked about that when we talked about mold. If you remember that, they probably have a county mutual in here somewhere. I don't see one right off the top of my. Not all of them are called Allstate. You see a lot of New Jersey companies. And why is that? Because New Jersey is a horrible place to do auto insurance. So they create special companies just for New Jersey. The one thing I learned at USAA is bank and insurance and real estate lawyers, anytime there's an issue, they just create a new company. You should have seen USA's real estate company, just like 70, 80 companies. It's like they have a hotel in Dallas who has got its own company. It's like, why would you do that? And it has to do a lot of, on the real estate side, it has to do with federal government non-discrimination rules. And it's not that USAA want to discriminate, it's that they didn't want to fill out all the paperwork for all of that and saddle everybody else. So you see these specific companies. And the life insurance side, they'll have a New York company. You notice how important states are, because you're seeing a lot of state specific companies, a lot of New Jersey. USA does not have that many insurance companies. They have a bunch of real estate companies, but they only have about 4 or 5 of the insurance companies. They have a few county mutuals, so they may have a few more than that. So this, you notice there's no life insurance anywhere in here. Allstate life insurance. So you might think this is all of their companies, but this is only their companies on the property and casualty side. As amazing as that is. So they got a lot of companies. And they're domiciled, they're licensed in all different states. You know, Allstate is an Illinois company, but here's a county mutual right there. And what state is that in? Texas. Just like you would expect. There's a Texas Lloyd. Where's the Texas Lloyd? Hopefully in Texas. The New Jersey companies in New Jersey, but not all of the New Jersey companies are in New Jersey. They've got a Massachusetts company, North Carolina companies for some reason. Got a California company that might be in the homeowner side. So, all right, so we come down to, I want to start walking y'all through Schedule P. All right. If I were you interviewing for a company, I would look at their Schedule P. First of all, just at the beginning of the interview, say, yeah, I was looking through y'all's Schedule P and I found it very interesting that you just said something 98% of their other candidates didn't say. So yeah, it's really interesting. Your Schedule P Part 7, you know, that's just real interesting. All right, so Schedule P has a lot of pieces to it. It's probably the next 60 pages of this thing. We're not going to use this first part, but it's just, you notice one thing in Schedule P is a lot of years. That's one reason I love Schedule Ps. You have a lot of years of data all in one place. So look at what they're showing you. So they're showing you premiums. Premiums earned, we'll talk about that term versus written. The other thing you notice is where reinsurance comes in. We talked about reinsurance earlier. You have direct and assumed. So what is a direct and assumed? Direct is the business they wrote. Assumed is the insurance they're writing for other insurance companies. So they're reinsurer. Ceded is the risk they're giving to another insurance company. So they're buying reinsurance. So assumed is they're selling reinsurance. Ceded is they're buying reinsurance. And then they do the net of those two. Then they have losses, both losses that are direct and losses they're paying for other insurance companies. And ceded, those are losses that they had that reinsurance is going to cover. Now, I don't know what happened in 2012, but they obviously had some major event. Boy, I can't remember. I can't remember what year Katrina was. Harvey was 17, wasn't it? I should write these down. I don't remember 2012. Katrina was like 08 or 09 or something, was it? Boy, all the years run together for me. 05. Yeah, so we don't even have that one there. But you could get 05 because they have multiple years of annual reports. So you could go back, you know, to the 2012 and that would give you 05. So you could get those numbers. So obviously, and you can really tell because there's a big jump in that year. What? I don't remember what year Sandy was. It doesn't seem like it was that long ago, but boy, years. I retired in 09, which seems like 40 years ago, but I can't keep track of time. There's stuff that happened 20 years ago I thought was yesterday, and there's things that happened last week, it feels like. So you'll see when y'all get old like me that time has no meaning. So it fluctuates quite a bit. That's probably coming from the homeowner side. More than likely the homeowner side and not the auto side. So ceded to me is really, really interesting because you see a big number in ceded, that means reinsurers reimburse. So they must have had, you only get reinsurance for catastrophes. You don't get reinsurance for the smaller claims. And then salvage and subrogation, what that is when you're in an auto accident and they total your car, they now own your car. And they're going to get anything they can get for the tires, whatever it is. So if they totaled your car, they now own your car. It's not inconsequential numbers, is it? We're talking billions of dollars that they're getting by reselling the stuff that they've replaced. So big numbers. So essentially, this is somewhat of an income statement before expenses. So it's like revenues, premiums minus claims. It includes loss adjustment as well. They break loss adjustment into two categories: defense and cost containment adjustment, and then salvage is in there as well. So what we're going to focus in on is part 2 and part 3. This is the real key. So we're on the exam, you're going to be doing part 2 and part 3. So we just have to figure out what part 2 and part 3 is. I love part 2 and part 3. In my consulting business that lasted for I got one gig, but the gig was to build a stochastic model for a P&C insurance company. And Schedule P, I had to build a Schedule P. That's the only way I could think to do it. And I had it. Unfortunately, the guy I was building it for was a life actuary, so he had no knowledge of P&C. But they want to start selling to this industry, so they wanted me to build a model so they could run all this. After I showed them everything, they decided it was too complicated and they just stay out of that business. So I saved them all that headache. But I had to build. If you're going to do a simulation model for a P&C company, you have to build it really at this level of detail. It's amazing how complex this business is. So what is part 2? Part 2 is incurred losses. So it says net, so that usually means net of ceded. So direct and assumed net. So you see the word net on losses almost all the time in this statement. It means net of ceded insurance. So it's less what they got from the reinsurers. And there's 2 periods of time here. Very, very, very important. Down the side is the accident year. These are accident years. Across the top is the fiscal year. And this, if I were trying to value these companies, I would be adjusting my historical earnings for what this table is telling me. So let's pick a year. I still don't understand prior. I'm still hoping for an actuary to go work in this industry and come back and explain to me what the prior line means, because it's very strange to me. You would think it's everything before 2012, but obviously it's too small to be the sum of everything. So maybe it's just whatever is outstanding as of for those prior years for 2012, but it still looks like too big, too off of a number. But anyway, let's just pick a year. Let's see. It doesn't look like Harvey was that year because it didn't really jump that year. So maybe 2016 something happened, but let's look at 2016. So what this is in 2016, for 2016 business, their original guess on how much they were going to have in losses was 20 billion.3. All right. 2017, they reduced that forecast from 20 billion.3 to 20 billion.1. They came down about $200 million. So what does that mean? So in 2016, they essentially expensed 20 billion.3 when the next year they knew that should have only been 20 billion.1. Which means, this is the tough part on the exam, did they overstate their net income in 2016 or understate it? So step back and think. They overstated their expenses by $200 million. So what did they do with their net income? They understated it $200 million, which is not a small number. That's a pretty large number. But not only that, the next year they came down another $100 million. The next year they came down about 35 million. Then they added about 13 million. And then all of a sudden they added another 100 million. So you can see how that's fluctuating over time. If you look at it over the long term, and what I ask on the exam is, what's the most accurate number in that list, do you think? What would you hope would be the most accurate number in that list? Anybody would agree that that should be the most accurate number in the list, right? It's the latest number. So if that's the most accurate one, how much did they really misstate this year? 20 billion.3 or 20 billion about 300 million. So they understated 2016's net income by $300 million. I don't know what their net income was back then, but let's see what page is that, page 30. Net income the last few years has been about $5-6 billion. So $300 million, about 5% or so of their net income. I've seen years, and I wish I could go back and show, I've seen years when the misstatement can be like 80% of net income. It can be huge because these things can fluctuate. Sometimes they're pretty close here. 16 billion, 8, 16 billion, 6, about $200 million misstated. You can kind of look down and see. Now, remember what Warren Buffett said, is that companies are really bad at these estimates and they generally are doing reserve strengthening. You don't see that with Allstate, do you? The first estimate, how often is the first estimate lower than the final estimate? There it's higher, there it's higher, there it's higher, there it's, wow, that's like, whoever, someone should have got a raise for that one. That's almost perfect. There is higher, there is higher, higher. Is that the first one that's lower? So there it's lower, 2019. There it was higher. So I think Warren Buffett, at least with Allstate, there's no evidence Allstate is systematically understating that first year in order to prop up net income. If anything, they're systematically overstating that first year, which is exactly what USA's actuaries told me. They put in a 3% cushion. Well, that 3% cushion is going to disappear over time as they pay their claims and they discover they don't need it. Because this is, the cushion goes into the reserves. This is not the reserves. This is the reserves plus the paids. So it's everything. So as you pay more, the 3% cushion goes into a smaller reserve. And so it declines over time. So that 3% cushion should over time reflect your final numbers should be lower by about 3% than your initial number. All right. So that's part 2. And the nice thing about part 2, say, I got to go down and find it. I think I just got way too many products. Let's see if I can find it. Part 1G, part 1H. I would do a search on it, but I don't know exactly how they had typed it. Part 1P. Yeah, try that. I was looking at your Schedule P, Part 1, Part P. They would be pretty impressed with that. All right, so here's Schedule P, Part 2, but just for homeowners insurance. So you can break it down by product, and then they'll have it not for auto, they'll have it for auto physical and for auto liability. What you'll notice with auto physical, what do you notice here? They only go back 2 years on some of these. So it depends on the product. So you can see the product line. So here's auto physical damage. They don't go back all those years because I don't know if any of you have had an auto physical damage claim that took 5 years to settle. It's just not going to happen. It's going to get settled probably within a month or 2. So you don't need to go back 10 years for that. Now, auto is in that initial schedule. Part 2 it's in there, but it's when you show the detail down here, you don't have to show all that. And then you just put the none button in there. All right, so part 2, let me go back 30. All right, so this is, sometimes they call this the ultimate. It's what each one of these is what they think they're going to pay over time. This isn't like building over time. This number is their estimate for exactly what they're going to pay out over time. Now, part 3 is really, really helpful because part 3 is what they've actually paid. So if you look at 2012, as of 2012, They thought they were going to pay out 16.8 billion. At the end of 2012, they'd only paid out 10.8. So they expect another 6 billion to be paid out over time. So what would the reserve, this is one of the questions I asked, what reserve would you have set up in 2012 for 2012 business? And it's real simple. You just take the ultimate that they expect to pay out minus what they've already paid out, and that's the reserve that would go on their books. Well, the next year, they paid an extra 3 billion. So the reserve is going to drop 3 billion, but then they also added about 50 million to the reserve. So they paid out 3 billion, but they said, oops, that's kind of that Warren Buffett, oops, we underestimated by 50 million. So you're going to see the reserve drop by like 2,950,000,000. So yeah, that's across. And then every year it's going to do that. And it's real important to realize as this ultimate changes, not as the reserve changes, but as this ultimate changes, these changes are misstatements of net income that they're making up. So you see the big debate between actuaries and the finance people. The finance people look at this and they go, okay, let me find a really good one. So like this one, $300 million. Finance people are saying, wow, got an extra $300 million. You did a great job. And so 2017 looks great. You did a great job in 2017. What did the actuaries say? No, we did better in 2016. We just didn't know it. So we were actually $300 million better in 2016, but we just didn't know it. But from the finance standpoint, all the accounting, all that $300 million is going through 2017. It has nothing to do with 17. It has to do with 16. So actuaries think in accident years, and you can see it's right there in your Schedule P.
Okay, so then, so part two, to understand correctly, so reading it from like 2012, the second line, that's what the thinking that they're gonna pay out.
Yeah, this whole thing is 2012, the entire thing.
Rest of those numbers, that's, you said, what their info was, or did?
Well, as of 2012, they thought they were going to pay out 16.8. At the end of 2012, they paid out 10.8. So they got to set up a reserve. So the reserve is going to be the difference in those two. All right. The next year, the reserve is still going to be the difference between that and this. But why did the reserve change? Part of it changed because they redid their estimate and they added about 50 million. But reserve also dropped because they paid an extra $3 billion in cash. So the reserve is what they still need to pay. And you can get it right out of their statement. But the other thing you can get, and if I were doing analysis of companies, I would take the Schedule P and I would start restating their prior year's net incomes. So if you're trying to say how well did they do last year, I want to know how well did they do last year if I had this ultimate, if I knew this column. And so I can go back and restate 2014 because I know, well, that one's not such a big one. I know their net income was actually higher in 2014 than they reported because they came down about $40 million, $50 million on their ultimate paid out.
Why does it take so long for them to draw it out? Those 10 years, 2012, 2021. Why do they keep adjusting to that data?
Well, okay, this is Allstate. They're mainly auto and homeowners, so it's probably mainly related to the liability side. You know, a home is gonna. There's no way you're gonna have a auto, especially auto is going to be resolved in 2 years. The bodily injury side, you know, you have someone that your customer injured someone else, and you're going to pay them out $50,000 a year for the rest of their life, and they die after 3 years. You know, that kind of stuff's still in there. It is pretty amazing how material it is. Now they added $30 million here. I mean, it's pretty amazing, but that's 30 million out of 16 billion. So percentage wise, it's not that huge of a number.
That makes sense. If you said it. I just didn't think about the liability.
Well, that's the other thing the actuary, we're going to stop here pretty soon, but that's the other actuaries complain about. This isn't what goes through the income statement is the change in this number. the change in this number can be really huge, can have big swings, but the actuaries say, well, no, but this number is pretty accurate. It's accurate, it only changed 1 or 2%, but 1 or 2% of 16 billion is a big number. So the accountants are like, wow, you made a big change. No, we didn't. We went from 16.5 to 16.6. I'm saying, but that's $100 million you just went through. So yeah, actuaries just get real frustrated with finance and accounting people. I was like, you don't understand this business. So what I want to do is show you the problems. Most students don't have too much trouble with these problems. They're pretty straightforward, not nearly as complex as the pricing. So this is somewhat of a gimme on the exam, but I do want you to understand it. And I do encourage you, if you interview with a company, see if you can get their statutory blanks and look through some of this. And just, you know, I need to go back and I need to write down when all the major hurricanes happened. You know, I don't know if I can get 9/11. 9/11 would be interesting with Chubb. I'd have to see if Chubb's is out there. And if I can go back to 2001, it'd be pretty tough to do. But, and I don't want to just see 2001. I want to see 2000 and 2001. I want to see how material that was. I doubt Berkshire Hathaway has their annual reports out there, especially for the reinsurance companies, but we'll see. All right, so it's pretty cool. I really love Schedule P. There's nothing at all like this on the life insurance side. So the life insurance, you're just kind of, it's interesting, but they don't have this. So this is, to me, the coolest thing. All right, we'll reconvene on this on Monday. All right, that's it.